Hello everyone. Recent regulatory interventions in the insurance industry have highlighted issues in established pricing practice which have not met customer and community expectations. In this context, and with evolving community expectations, the rapid advancement of technology and data capabilities, what are the responsibilities of insurance professionals to protect the public interest in insurance pricing? A working group of actuaries explored this question in a paper titled Protecting the Public Interest in Insurance Pricing. Colin Priest and Dale Jackson are two members of this working group and join us today for a discussion on the paper. Colin is going to start by providing a brief overview of the paper, and then Martin and I will chair an extended Q&A session on the paper. To ask your questions, please go to the Q&A icon on the Summit HQ app. The link to download the app can be found through your name tag QR code. And for our virtual attendees, you should already have the Q&A on the right-hand side of your screen. Now, before I hand over to Colin, I'll give a brief introduction of the four of us. Colin is a seasoned business leader with more than 30 years of experience across various industries, including financial services, technology, healthcare, security, oil and gas, government, telecommunications, and marketing. With a focus on data science initiatives, he's held several CEO and general management roles, while also serving as a business consultant, data scientist, thought leader, behavioural scientist, and educator. Dale is a director at EY with over 12 years of experience consulting to Australian and New Zealand life insurers, reinsurers, and superannuation funds on a range of topics, focusing on insurance pricing and product issues, including sustainability in individual disability income insurance products, decision-making in members' best financial interests, and responding to regulatory change. Martin Mulcair is an FIAA who is currently enjoying a portfolio of activities, including roles as a company director, business advisor, mentor, and facilitator. In Martin's prior career path, he has more than 25 years' experience in actuarial and executive roles in the financial services industry. In the context of today's session, Martin is a member of the Institute's Professionalism Committee and has been involved in several insight sessions related to the Code of Conduct. Many of us will know Martin as the facilitator of the Professionalism course for the Actuaries Institute from 2009 to 2019. I'm Kirsten and I'm a Senior Pricing Actuary at RGA Australia. I'm also a member of the Life Insurance Practice Committee. It's through this committee that I became involved in this paper. Initially, I helped with the recruitment of volunteers like Dale to provide a life insurance perspective, and I subsequently served as a reviewer of the paper. So, over to you, Colin.
Thank you. Okay. I'm going to skip over these. Right, let's get into the introduction very quickly. We're covering a range of different topics. The working group was initially prompted by a particular problem, and that was that the pricing practices of certain insurers, especially price elasticity, was undoing the pricing promises that marketing and sales were making to those customers. But as we sat and chatted, we found that the scope needed to be broadened. How do we make insurance pricing consider the public interest? Now, we don't actually explain the code. We assume you know it. If you don't, you've probably got a professionalism problem yourself personally. But I do want to point out a few things from the code that are particularly relevant to the topic today. Now, the code says we have a duty to the public, not just to our employer, not just to our client. Unlike if we were lawyers, professionalism in the legal profession is about doing what is right for your client. We work differently. Our professionalism is about protection of the public. The other part is it specifically calls out that you must have due regard to other interests in any decision that is made other than just your client. Speaking up. When we discussed some of these things in the working party, it was, but what about people that just do the numerical analysis? Why why should they be involved? Well, the thing is, the code says they must be involved. You must speak up when there is non-compliance by others. You are responsible for speaking up when the downstream use of your work is not appropriate. You must speak up before any harm is caused. Don't wait for things to go wrong and then, okay. You've got to be proactive. And down the bottom here, you've got to speak up even though it may have serious implications for you. You have a duty to others. As actuaries, we have been given a place of privilege, but to balance that out, we have been given very strong responsibilities that we must stand up to in order to be professional. The fact that you may lose your job, you may have other negative consequences, should not stop you from doing the right thing. So we came up in the end with a bunch of general principles. We are trying not to be specific because the world is too complex for a working group such as us to cover every edge case that's out there. And we came up with 6 principles here of what you should consider when doing insurance pricing. We've got transparency and disclosure. This is about enabling insurance customers to make informed decisions. They can't make informed decisions if they're not informed. Value for money and affordability. If you've got a product out there and its loss ratio year in, year out is less than 50%, what's the value for money in that? And I'm not saying it's necessarily wrong, but you're going to have to think carefully about whether that is fair and reasonable. Anti-discrimination and fairness. Well, we were talking about fairness. Are the consequences of some of the things you do impacting vulnerable people more? This came up initially when we were talking about price elasticity. Do people that speak English as a second language have lower price elasticity and therefore you're charging them more, for example? Responsible and appropriate use of data. You've already got compliance requirements about that, but think beyond that towards the ethics of that. Perverse incentives. I've got to say my favourite one is when we pay people to rebuild in a flood zone, personally, but that's a perverse incentive if you ask me. But there are other things out there. Does your pricing encourage people to actually take more risk or to dump consequences on other people? Are you pricing less for gas-guzzling, carbon fuel, world-destroying cars than you are for cars that look after the environment? And sustainability, talking about the environment there. These are our principles. And that's what I want to leave it for at the moment. We can get into the discussion led by my 2 colleagues here. Oops, pushed the wrong button there.
Okay, thank you. So Martin and I are going to kick off the discussion with some questions that we've already prepared, but please send through any questions you have and we'll make sure to ask those as well. So I might get started. Dale, why did you join this working group?
Good morning, everyone. I joined really out of recognition that actuaries haven't always got it right. There's a number of high-profile, issues in recent times that affect the life insurance industry, just as much as general insurance. And I was keen to be part of a group that would examine that and see what we could learn from it.
Yeah. How about you, Colin?
The short answer is because Moodit told me I had to. The longer answer is I've been a little bit outspoken. That's probably an understatement. I'm known for being outspoken, but about some of the practices in the industry. And Moodit was chatting to me, and he came in the consequence of price elasticity. And I remember when I built my first price elasticity model in the mid-90s, this was not what I had in mind. It was purely that I could shut up the marketing person, stop blaming me for the sales being low.
So this has been a really long time coming piece of work. Colin, can you outline the timeline of the activity for the progression of this paper?
We started roughly mid last year, and we split off into, we had a quick chat and then we split off into 2 groups. And one group that I looked after was about education. We made life very, very difficult for Mike Callan, if he's in the room. I don't know if he is, because our goal was to come up with things that are missing in actuarial education. And that one was, I've got to say, I got the easy group, even though I made life difficult for Mike. The other group was focusing on what should the principles be. After about 6 months of that, we regrouped and reorganised because we were focusing on how can we create a paper to put all this together. And we split off, and each group did different parts of the paper. And then was the horrible bit. This has got to be the most reviewed actuarial presentation in history. The number of people who had an opinion about this, who thought something should be changed, was astounding. And when we've tried to navigate our way through that, but there's no way we've made everyone happy.
Well, I'm sorry for my contribution to that as one of the many reviewers.
You don't look like you're sorry.
I'm interested in your personal experience, your kind of almost emotional connection to this topic. Dale, I'll start with you. Have you ever been in a situation where your pricing analysis created some ethical issues?
Absolutely. So before consulting, I was working for a life insurer, relatively newly qualified actuary, and it came up several times. And I think one particular example that sticks with me was actually peer reviewing a pricing report for someone else, and there was a quite significant apathy factor, which reduced the expected claims rates. And so I asked a few questions about this, and it quickly became clear that, well, that's because we expect many customers to either firstly to be paying premiums, but then to not be aware of the cover they have and to not be claiming ultimately. And then the pricing and the profitability was really dependent on that factor. Now, at the time, did I do the right thing in terms of the code, etc.? Probably not, but I think it just shows that these sorts of situations come up quite frequently, and we've moved on a bit since those times, Royal Commission, etc. But I think the future will still have further, different challenges for pricing actuaries.
Okay. Well, thank you for the example, and also thank you for acknowledging that perhaps you didn't do as well as you might have in the benefit of hindsight. Colin, what about yourself? One example of where your pricing has created some ethical issues?
I'm going to admit that I'm not perfect either. So New South Wales CTP. I've been involved in the pricing of that various times through history. And at one point of time, there was a pricing, you've got to lodge your pricing assumptions. And I'm looking at it, and I wasn't the one signing it off. It was one of my staff members. But I'm looking at it, it was just padded everywhere. Every assumption had some padding on it, because in New South Wales, you're capped at what profit margin you could put in. And so what they were really doing was charging a higher profit margin, but pretending that they were being compliant. And I internally objected to some of that. I refused to put my name on it, but I didn't speak up externally. Now, at the time, the code didn't specifically say I had to. Now it would, but I still think that the code implied that I probably should have done more than I did. It was price gouging, basically.
Again, an interesting example, and our time machine isn't working to be able to go back. Just a different question. A couple of principles that you outlined brought in the concept of fairness. I have the joy of teaching ethics at a primary school, and the 7-year-olds love talking about fairness. What do you mean by fairness? Dave, you want to first shot? What do you mean by fairness?
It's really challenging, and it means different things to different people, I think. you know, to me, when something doesn't sit right, and you know, you examine the winners, the losers, and you know, that really sort of, you know, is a bit of a gut feel sort of test. But as a working group, I think we acknowledge that there's not one universal definition, and you know, focused our thinking towards those that are vulnerable. You know, where they are a loser from a particular decision, if you like. You know, are they the type of customer that would be, you know, disproportionately affected by that decision? And you know, is there a different way that would get a more fair outcome across the group?
Okay, so it's an interesting approach to fairness, thinking about it through people who may be adversely affected. Colin, what's your understanding of the term fairness in this context?
I was going to give one that had jargon in it from ethics, and Dale's better at communicating than me, apparently. I was going to talk about harms, but when I wrote about harms in the papers, a whole bunch of the reviewers going, what the hell are you talking about? But I like that winners and losers phrasing. To me, I like to define fairness in its lack rather than what it is. So people react when something is unfair. And unfair is when someone loses but doesn't deserve to lose. That's the way I think about it. So it could be that you lose out on a better price because you're elderly and you don't shop around as much. Do they deserve that? Some people would argue no. Some people would argue yes, but there's always a few sociopaths in every crowd. Another one is, but I reduced my risk, why did you put my price up? That's unfair. It's because you have been a loser out of something when you didn't deserve to be.
Interesting. Again, you've thrown up an interesting term, the word deserves. Anyway, it'd be interesting.
Yes, the whole thing is very vague,
that.
and that's why we stuck to principles. If you try and make this legalistic, you're just going to tie yourself in knots.
Yeah. Which, of course, was the argument for having a principles-based code of conduct as well.
Yeah, and that's why I like that Australia has this concept of the pub test. Would you be happy talking about doing this at the pub? Would you feel safe saying what you did at the pub?
Well, we have a question from the audience that probably leads itself quite nicely into fairness, but maybe also perverse incentives. Recent reports suggest electric vehicles will have higher repair costs than petrol vehicles. Should some level of cross-subsidisation take place if it may be unethical to have lower premiums for vehicles destroying the environment?
I just bought a car yesterday.
An electric vehicle?
I got a hybrid in the end. I was thinking about electric vehicles, but I'm renting, and so I can't put in a charging station. I thought, okay, I'm going to at least move to something that's better. There's no right or wrong answer to this. This is one of the tricky things here. You've got to balance the things, but make a conscious decision rather than just defaulting into something. Sit there and do both sides. As an insurer, it's not just about that individual policy that you are writing. You've got other policies that are affected by the climate getting worse. You've got to think about that. You've also made, typically in Australia, public statements about how you're trying to do the right thing by the climate. You've made a promise out there. Are you keeping that promise? I'm not saying you definitely should, and I'm not saying you definitely shouldn't, but you should think this through very consciously and document your thoughts.
I think that's a really good point about, like, it's thinking through. There's no clear-cut answer to a lot of these questions, and a lot of the problems actuaries are faced with these days are problems we haven't been faced with in the past. Okay, so I'll go to a few more audience questions. What are some of the key issues where actuaries hold different opinions?
You do a life insurance one?
And that might come out of the review side of things. Like, where was there some debate?
I guess I was thinking, you know, the industry now and you know, some of the debate around, you know, what's driving experience for particular product lines, and I guess what what is a sound technique on certain things, so IBNR delays, etc. So, you know, there's definite scope for different approaches. In terms of the paper itself, I mean, we went through so many iterations. It's hard to narrow it down to one example of where the debate really was. But
we've got quite a few questions from the audience, so I'll keep going through them. How should we manage the potential conflict between the code obligation to speak out, possibly externally, and legal or contractual duties of confidentiality to one's employer?
I have in the past forced employers to change my employment contract to specifically exclude confidentiality from where I have professional obligations to speak up. I had to get lawyers involved. That's how fussy I was about this, but you should do that. I think in general, if an employer tries to enforce a non-disclosure on you and you consider that unethical, you should ignore that. Now, that's not legal advice, it's my personal opinion. There's probably the Institute cringing here as we, you know, I'm not representing the Institute when I say that. I was just very, very clear here. But maybe what you should be doing is reading your employment contract and raising it. If you're in a large company, go and find the senior actuary and raise that as something as an issue for all of the actuarial employees in the company.
So, Kirsten, if I may, on that, it's important that when we're thinking of speaking up, and if we differentiate speaking up from whistleblowing, which is a different subset, but our first thought in speaking up shouldn't be external, right? Our first thought should be, as Colin suggested, thinking about who are your peers, testing the idea on them, who do you report to, and thinking about what's practical but especially helpful channel within your organisation before you contemplate any kind of external. And remember that the wording of the principle in the code does not expect you to be breaching any laws in doing that.
But I've got to say, anyone that was involved in Hardy's asbestos has heard of it. That's one where even the people involved would say they should have spoken up even though they had a non-disclosure.
Did the working party consider additional issues around compulsory insurance, where the customer doesn't have a choice, particularly that it removes the customer power in terms of decisions around value?
Yeah, so in the paper we specifically call that out. The ethics are different when something is compulsory versus when something is someone's choice. So if you look, I'll come back to CTP because that's a classic example of that. The ethics of cross-subsidies in a compulsory class are completely different to the ethics of cross-subsidies when something is optional. The ethics of cross-subsidies are completely different when the true beneficiary is not the person buying the insurance. You know, in that case, it comes back to CTP again, the beneficiary is not the driver, typically. It's the person they crashed into and seriously injured. You want to make sure that that's who you're protecting, not necessarily the policyholder. So we call that out. You know, you've got to be very specific to the circumstances when you think through the application of the principles.
It's probably a good time to plug and say, if you haven't read the paper, you should. You can find it on the Summit website under papers for the Summit. Dale, I might put this next one at you. In light of the current cost of living crisis facing society, is there potential for insurers to explore strategies aimed at limiting premium increases for the greater benefit of the public interest? So we've certainly seen that in the disability income space where there's been massive increases in IP premiums.
Yeah, and I guess there's two sides to premium increases. There's premium rate increases and the sort of automatic increases that are built into the product around age and CPI. I recall, I've never seen it in probably the last decade or so, but I recall a version of of a product that had a decreasing sum insured, a retail life insurance product that had a decreasing sum insured and what you might call a more true level premium, presumably because it would help perhaps cover debt that was being paid down and be more affordable over the long term. I just haven't seen that for quite a long time. So I think yes. It's still a challenge though. You still got to price for the risk. That's one, I guess, principle that is being talked about in that question, and it's there's 6 principles, so it's still a lot to think about.
Yeah. One related question that just came through is, how do you deal with public interest issues where the perceptions are arguably based on a faulty premise? For example, customers thinking that price increases are unfair if they're higher than CPI. So what if the customer expectations aren't right?
Well, I think, and as the working group, we talked about supermarkets, and Woolworths was in the news, etc., in recent times, and that was a topic for discussion. And I think the learning out of that was, well, perception and reality are not the same, but they both matter. And I think that question's going to perception that's maybe out of line from reality, but it still needs to be managed and maybe tried to be brought back into line. But that gap might be due to a bit of a trust issue or a communication issue, a transparency issue.
Yeah, I was going to say disclosure and transparency become to the forefront as a principle when that's happening. The reason people don't trust insurers is because they've got no idea how the decisions happen and why. And the psychological research shows that the less that you understand why something happens, the more you distrust it. And the more complex it is, the more you distrust it. Well, gee, there's a double whammy for insurance. Even the actuaries often don't understand.
We might move to some of the other questions that Mud and I had that we wanted to ask. And you just touched on the supermarkets, but Colin, maybe optimisation and loyalty tax are pretty common in other industries. What's so special about insurance, and why more care, scrutiny about what we're doing in the insurance space?
So as someone who's in the process of moving countries, I'm very aware of airline prices at the moment. And airline prices use price elasticity. The prices change from day to day, both on demand and supply. They're looking at how many seats they've got left, how many people want to fly there. Is it a busy time? This conference is at a busy time, so my flights cost me a bloody fortune, I've got to say. Now, one of the things that is different about insurance, I was already just alluding to, is the complexity and the opacity. If you look at something that's everyday, like motor insurance, you know how complex comprehensive motor insurance pricing is. I was doing work in reverse engineering competitor prices 20 years ago, and it's incredibly difficult for an actuary to figure out how an insurer is pricing. How is a layperson supposed to do that? And then you add on top of that price elasticity that is more complex than the airline price elasticity models, and it's a recipe for distrust. It is a recipe for things to go wrong as well. So as I said before, when you disconnect that from both ethics and technical pricing, things go wrong. So what was happening was price elasticity was undoing marketing promises about discounts for not having a claim, for example. There's one very well-known insurer, one in the top 3, that basically had a penalty tax for if you were old. And they're one amongst the most vulnerable people in Australia. They didn't grow up with technology, they're uncomfortable with the internet, they don't like shopping around, they have a lower income typically, and yet this insurer was charging them the most highest profit margins of anyone in the portfolio. But no one knew that except the industry insiders.
And maybe if I could take the loyalty tax part of that question from a life insurance perspective. So absolutely there's many industries that charge less for newer customers, and price goes up over time the longer that you're with the company. But in life insurance, there's duration-based pricing. It's become a feature of the market, and there is a rationale behind that. People underwritten, their risk is lower at their initial sort of policy inception, and that underwriting, if you like, wears off.
By the way, the opposite is usually the case in general insurance. Your new business is normally the worst. Sorry, go on.
But I guess from a life insurance perspective, this really encourages, or it sets the scene to encourage further switching of providers. As price goes up relative to newer customers, if you're in good health, then you are somewhat incentivized to switch and shop around again. But we also know the economics of life insurance are really, long-term, high acquisition costs, at least at the moment. And hopefully that changes over time. But it seems like a strange sort of behaviour to encourage through this type of pricing.
Yeah, and I think it becomes more of an ethical issue when it's sort of a necessity. So airlines, going on a flight is not a necessity, but protecting your home is. The other one that people react strongly to is your mortgage, having a home. As someone who has a couple of mortgages, I've been feeling the interest rates going up. And I go to the bank and I'm going, look, there's what you're advertising. So no, we're not giving that to you. That's only for new mortgages. I go, I've been a customer of you for more than 50 years. And I'm thinking, but wait a sec, that's probably why they're charging me so much.
It's really hard with the lights to get a feel for the profile of the audience today and what degree of roles or experience they might have. But I'm interested for both of you. Perhaps Zoe can go first. Does this discussion, do these principles matter if you're just the number cruncher rather than the person who's got some authority or responsibility for actually setting the premiums?
Absolutely. You may not be the ultimate decision maker, but you need to advise the ultimate decision maker. You need to put your hand up and be clear on what the issues are. And actuaries most definitely are the ones at the coalface, and can understand them to a greater depth generally. So absolutely this matters.
Yeah, and in general insurance, it's very different to 20, 30 years ago when I was first in the industry, when there was maybe one actuary in the company. There are now teams that do nothing other than the mathematical modelling of the risk premiums. And you could argue, well, what's that got? None of this has got anything to do with them. But they do have a consequence to inform the downstream decision makers of potential problems from different types of decisions of using their work. And that's always been a requirement of the code, by the way. These people, because they've done the analysis, probably have a better insight to what could go wrong than the people downstream. And so it's our duty as a professional.
Okay. So even if one sees oneself as the number cruncher, we certainly value our expertise, we value our analysis, so perhaps at least putting some thought to the application of those principles that you outlined.
Yeah, and we can't rely on that, the World War II Nuremberg excuse of I was just following orders. Yeah. This is my job, I don't care about the rest. Yeah. It's part of that position of privilege as professionals.
A very related question to that from the audience. Can you discuss the use of sophisticated black box models which may have unintended pricing impacts on certain socio-demographic segments? How deep should one go to ensure compliance with your principles?
As deep as required is the quick answer. So there's going to be some follow-up work from this working group that I'm going to run, which is about worked examples of how you can analyse pricing models to test for different ethical issues that may be arising from it. There's, by the way, more than 20 different mathematical metrics for fairness, and you can't ever achieve any more than 2 of them at once. But you need to know what they all are because you've got to choose the right ones for the stakeholders. Every stakeholder has a different idea of fairness and a different metric.
Colin, you talked about this in your introduction, but I might get Dale to answer. We talked about demand elasticity in pricing as a motivation for this paper. Do you think current practice in using elasticity fails the public interest test? Like, should we not have those kind of models at all?
I think similar to Colin's comments, you need to be very careful in using those kind of models and understanding the outcomes and the consequences. I wouldn't go so far as to say throw them out altogether.
Was that God sending some thunder to warn you?
You must have said something earth-shattering there.
I will give an example of price elasticity use where I think it might make sense for all. So we're talking about huge increases in prices for some insurance. Think about flood insurance in Australia and how much the prices of that are going up. Now, if you looked at a price elasticity model, you'd be saying, it would say, okay, don't increase immediately, spread it over time. Now, that actually is very good for the insured. As you might imagine, you're going to charge them less, at least in the short term. But it could be better for both the insurer and society as well. Churn of business costs a lot for insurers. It runs up very big expenses. It's the same for if the intermediaries involved. The whole system becomes less efficient when there's lots of churn. So it might make sense to use price elasticity to moderate, to amortise that increase over time. And so that's an example of where doing that and using it in an informed way could actually be easily justified.
And it also, I think a good point out of that is price elasticity doesn't always disadvantage the customer.
That's right.
It doesn't always mean a higher price. There can be positive outcomes for the customer out of those models. Yeah. Is any cross-subsidy in insurance pricing fair? There's always a loser. Do they deserve it?
So I've already given the example of a compulsory CTP product. It makes a lot of sense for that to be cross-subsidised. Because you need to have that cover for the people injured. It's got nothing to do with the actual drivers.
How about in life insurance, Dale?
No, I'd agree with that. Wouldn't want people to leave here today thinking we're saying that all cross-subsidies are bad. It's just, the consequences of those and the rationale for them need to be assessed and, winners and losers. But, is there a sound rationale for, certain customers or members paying a little bit more so that insurance is more affordable or accessible for a more vulnerable group, for example?
Yeah, and I'll give an example that is more grey, and this comes back to EVs that we described before. So they're fairly new to insurers. Therefore, there's more uncertainty about what the correct price is. Now, some actuaries will go, let's be prudent, let's put the price up. Others would say, okay, this means we've got a huge range, we can move it up or down to suit market. You could argue either way, but then you've also got to bring in perverse incentives. Are you going to incentivise people to not do the right thing by the climate? There's a bunch of things there, and that's why it's a grey area. Do you want to cross-subsidise that? Do you want to,
I'd also like to think that discussions around a concept like cross-subsidy aren't just happening at the lower management levels, so that it's higher. In fact, I had the joy of being on a board where part of the articulation of risk appetite involved how much do we accept in terms of our risk appetite, how much do we accept the concept of cross-subsidies in this business. So you'd like to think that some of these principles were also being considered at the highest levels in the organisation.
Now, big question. Is the problem bigger for general insurance than it is for life insurance?
I don't necessarily think so. I at least think it's these principles are applicable to both. There's examples, and in the paper you'll see case studies that are life insurance related. So I don't think there's a reason to believe that it's only a general insurance issue.
I think they're more likely to happen in general insurance, just because the pricing is usually more complex. And complexity theory tells you the more complex something is, the more likely something is to go wrong. So it's in that sense, but the principles are the same. Sometimes the focus is a little bit different between the industries about what can go wrong. But the general principles are just very valid to both. And I'd say even beyond that, to health insurance, I've been applying a whole bunch of things from data science to this as well. It's quite broad, and also retirement income. You think about the compulsory life insurance cover that sits in some of these superannuation funds, and the ethics of the pricing of that.
I might ask one last question and then let Martin ask a final one. I'll start with you, Dale. With all these issues at hand, so unfavourable public opinion, incorrect pricing, do we have a market failure situation?
No, I wouldn't go so far as to say that. I think by and large, the insurance industry, serves its purpose well for the majority of customers. But there's always room for improvement. There's always going to be challenges for pricing actuaries emerging from new ways of analysis, new trends in the industry and in behaviour of customers. And I think, like we saw and heard, for those of you who were here yesterday, there's a lot of discussion around in life insurance the suitability of particular products and how they could better meet customer needs. I think there's also room for improvement and a natural sort of evolution of practice on the pricing side as well to match those changing community expectations.
What about you, Colin?
I'll hedge my bets and say a bit of both. I think there have been market failures, but market failure sounds so final. The thing is that when they come up, either the regulator or the insurers get around to fixing it. So I think what we're doing is not saying that the industry has failed, but there have been failures, there will continue to be failures, and here is a better way forward that will make it less likely to happen and easier to mitigate when it arises.
So you pick up the theme of better way forward. Colin, you outlined the timeline for the working group, and clearly you've also mentioned there's been a lot of input. So at this stage, how confident is the working group that application of those 6 principles will actually be beneficial and effective?
Oh, I'm going to say something controversial, just so people remember the session. We are more confident than the Institute is of this. There was initially, this paper was meant to be a position paper by the Institute, and the Institute doesn't want that. They're taking a legalistic approach to this, and they're scared to death of putting their name against many of these things. That's their choice, but the members of the working party are a lot more comfortable, probably because we've put in all the time to make sure that it's right.
Okay. Dale?
Yeah, I think explicit consideration of all these principles must put us in a better position for better outcomes going forward.
Yeah. And I've been living in Singapore for the last 15 years. The Singapore financial regulator basically forces financial institutions to do this. And they're principle-based, again. They didn't take a prescriptive approach other than to say, you must follow these principles, and we're going to come and look, and you're going to show us how you followed these principles.
So I think the hope probably in Australia, though, is that we just do it ourselves and we don't need the regulator to tell us.
You'd hope so.
Yeah.
You'd hope so, but I think some of the problem is many people don't know what to do. And so what we're hoping to do is give people some guidance of where to start.
Well, we're almost out of time. Thank you both very much, both for your time today, but for the involvement you've had in the working group in putting together this paper. For everyone in the audience, if you haven't already read the paper, please do. These are very important principles. There's some worked case studies in the paper that you'll find interesting for both life insurance, general insurance, and you can find it on the All Actuaries Summit page under papers. So please join me in thanking Dale and Colin.
Thanks, Dale.
Thank you.
Good work.